The global luxury goods industry occupies a unique position in the modern economy. While mass retail sectors compete on price and volume, luxury companies monetize scarcity, identity, and absolute pricing power. This business model requires relatively low capital expenditure because the brand equity itself functions as an intangible economic moat. Historically, this has produced unusually high gross margins and returns on invested capital that frequently exceed 20%. For the last decade, this baseline was amplified by exceptionally low interest rates and an expanding global money supply. This flood of market liquidity created a tailwind that benefited the entire sector simultaneously. Luxury demand reached deep into the upper middle income bracket as consumers felt significantly wealthier from the rapid appreciation of stocks, property, and crypto assets. This wealth effect supported spending confidence even among buyers who lacked ultra-high net worth status. This chart illustrates the financial anomaly of that period. Luxury firms achieved simultaneous volume and margin expansion. A $3,000 handbag became easier to sell at a 70% margin when the customer base perceived their own net worth to be rising alongside the broader market. This alignment of brand power and limitless liquidity created a financial baseline that many investors assumed was indestructible. But that assumption was about to meet a structural shift in the macro cycle. The environment has changed. Interest rates remain structurally higher than the loose conditions of the 2010s. Higher financing costs reduce speculative liquidity and compress the discretionary spending flexibility of the aspirational consumer. On the surface, luxury firms continue to report stable revenues. However, the quality of that growth is weakening as sales become increasingly dependent on price hikes rather than unit growth. We can see the mechanics of this illusion on the scale. If sales volumes decline by 5%, but management raises prices by 8%, reported revenue still looks positive. The top-line growth remains, but the actual customer base is contracting. This line graph tracks early warning signals of demand normalization. As same-store sales flatten, partners reduce orders and inventory turnover weakens. Crucially, when inventory growth aggressively outpaces revenue, it creates a drag on working capital, signaling stress months before headline earnings reflect the slowdown. During this phase, capital allocation becomes critical. Historically, the strongest firms maintained conservative balance sheets with high cash reserves and limited dependence on debt. Because luxury brands can scale earnings faster than physical assets, brand equity acts as a force multiplier for returns on invested capital. This is why leading firms have historically maintained such high ROIC profiles. Investors, seeing these resilient economics, have traditionally awarded luxury stocks a significant valuation premium, often trading at 30 to 40 times earnings. But risk emerges when those valuations assume these economics are permanently immune to macro cycles. If underlying free cash flow growth slows into the single digits, the stock price can quickly disconnect from operational reality. In a sector driven by perception and scarcity, valuation compression can occur even without a catastrophic drop in earnings. Markets simply begin to doubt that the prior growth rates are sustainable without a flood of credit. As liquidity tightens, the financial mechanics that once amplified profit margins are now masking an underlying operational fragility. Geography is also a factor. Over the last 2 decades, Chinese consumers became the dominant engine for incremental luxury growth globally. That engine is now stalling. A slowdown in Chinese property markets is materially altering sector economics, removing a primary source of consumer confidence. This is compounded by weaker youth employment conditions and a broader reduction in consumer confidence across the region. This creates a significant concentration risk. Even if performance remains stable in other parts of the world, it cannot fully offset a deceleration in the region that previously drove the most growth. The sector also faces a demographic split. Brands that rely on aspirational middle to upper income consumers are more sensitive to rising mortgage costs and credit conditions. They face far more cyclical pressure than firms focused strictly on the ultra-wealthy. This dependence on a single geographic region and credit-sensitive consumers transforms brand equity from an economic moat into a cyclical vulnerability. In a true recession shock, the impact begins in the financial markets. A global slowdown reduces asset prices and weakens bonus-driven compensation in sectors like finance and technology. This flows immediately into luxury economics. Store traffic slows, tourism spending weakens, and consumers begin retrenching on high-margin discretionary purchases. Here, operating leverage begins working in reverse. Fixed retail costs for flagship locations remain elevated, while sales growth stalls, causing operating margins to compress rapidly. To manage the resulting inventory accumulation, some brands may resort to selective discounting. This provides short-term cash, but inflicts long-term damage on the perception of exclusivity. Free cash flow weakens as working capital absorbs more liquidity to carry the unsold inventory. The very mechanics that generated massive profits now work to destroy cash. The shock reveals which companies built their success on durable brand loyalty and which were simply riding a wave of temporary liquidity. Survivability in a downturn depends on the balance sheet. Firms with low net debt and strong interest coverage can continue to invest in marketing and preserve their pricing discipline. This contrasts sharply with highly leveraged newer entrants, who may be forced to cut advertising or rely on promotional activity that weakens their brand positioning for years to come. These are the indicators to monitor: rising inventories relative to revenue, declining same-store sales, and weakening free cash flow conversion. When these dials turn red, the business model is under terminal stress. In the optimistic scenario, structural global wealth creation remains strong enough to restore volume growth once the credit cycle stabilizes. The downside risk is that the previous surge in demand was not structural at all, but merely a side effect of cheap credit, leading to a permanent reset in sector valuations. Ultimately, resilience in this new cycle will depend entirely on balance sheet quality and the ability to maintain pricing power without the support of asset inflation. With liquidity conditions structurally tightened, luxury firms must now demonstrate that their massive market valuations rest on durable financial performance rather than a temporary abundance of credit.